welcome to this Chazen Global Markets presentation. Let's first a bit about the Chazen Institute. Obviously, it's the global institute, not just for the business school, but really for much of the university. I'm Glenn Hubbard, the faculty director of the institute and a professor at the school. Next year, we got our 35th anniversary of the Chazen Institute. One reason I bring that up is Abby and I are going to talk at the beginning about uncertainty and changing times. This world looks a lot different than 1991, which was a high water mark of globalization, what economists at the time would have called the Great Moderation. Bad policy is all gone. We're in a new normal. We're in another new normal, and we're going to talk about that. Abby and I will have a conversation, but we would also, of course, have plenty of time for you to ask Abby any questions you want. It's a real treat for me to be with Abby Joseph Cohen here. The first and most important part of the treat is that she's my colleague. She's a professor now here at the school, having spent a very illustrious career in finance as chief U.S. investment strategist at Goldman Sachs, frequent on Barron's and market commentary. Unlike anything I may say, what Abby says is market moving, and you could, I'm sure, get your phone out and trade on it. She has been a great friend of the school for a very long time, a wonderful teacher as well as investment strategist. So it's a real treat to have a conversation. So Abby, just to welcome you here. Thank you. I mentioned the word uncertainty. And of course, to us as economists, uncertainty is very different than risk. Risk, you know what a distribution is, and you can characterize it as tight or spread out or skewed. With uncertainty, you don't even know what the distribution is. And it's a whole different kind of economic problem. Can you describe over the course of your career moments where uncertainty, either in markets or economic data, shaped your market calls? And how did that shaping help you develop a process to filter uncertainty in the way you think?
Glenn, that's a great way to start, and also a great way to introduce myself to all of you. During my career as a market strategist, my work was informed by being very diligent in terms of thinking about the data and also taking advantage of my background in economics and computer science and model building, but also taking advantage of the great environment in which I was working. That is to have colleagues who were expert in following specific industries and companies and getting their insights and trying to, if you will, compile it. I have found over the years, Glenn, that the most useful thing that I could do for our clients who were portfolio managers, but also business leaders, was to think about what was missing from the consensus expectation. If we consider, for example, a bell curve distribution of potential outcomes, the consensus is usually smack dab in the middle. And sometimes it's pretty tight around the middle, sometimes it's spread out. But I think the best opportunities either to make money or lose money are found in the tails, because that's what is not yet priced in to the marketplace. Now we're all in the dark. Oh my gosh.
Yeah.
So
cocktail lighting.
So what were some of those opportunities and then the risks? And the example I would use would be at the beginning of the 1990s, there was actually not that much enthusiasm in the marketplace. We look back now and say, wait a second, moderation in inflation, sensible economic policy. The US economy was about to undergo an increase of substantial proportion in growth and improvement in productivity, and yet investors didn't believe it. What was priced in was the expectation of ongoing stagflation, and what was priced in was the expectation that the United States would be losing its dominance in the global economy. Turned out not to be the case. And one of the hallmarks of my career was that I was among the most optimistic at that point. Why? Using my background and willingness to dig into economic data and also my knowledge of computer science, I thought we were probably on the edge of what would be a surge in investment in technology-related spending. I felt that the equipment that was increasingly available, i.e. PCs, who had ever heard of personal computers in 1990, for example? The advent of some of the communications associated with that and so on. And then looking through the work of my colleagues, seeing that companies were getting enthusiastic and they were investing in all of this. And so in the beginning of the 1990s, what was missed by the consensus was that there was, in fact, an ongoing evolution in the US economy away from the heavy metal bending industrial side of the economy towards much more advanced manufacturing, towards technology, and also importantly, towards advanced services. It was a great opportunity. There was a huge improvement, not just in profits, but also in the willingness of investors to pay for those profits. And in fact, the PE ratio for the S&P 500, which had begun at something like 8 times earnings, moved up, as you probably know, in 2000 to something like 24 times earnings. So we're talking about a tripling of the valuation. And in my work, Glenn, I look not just at the fundamentals of the economy and the companies, but what's priced in. You can have an ugly scenario, but if it's priced in, there's not that much risk. You could have a beautiful scenario, and if it's already priced in, there may not be very much opportunity. And in 1998, actually, 2 years before the peak of the dot-com bubble, I stopped forecasting the NASDAQ, telling my clients, I can't forecast the NASDAQ because at that point, most of the largest companies traded on the NASDAQ had no earnings, and some of them didn't even have cash flow. Well, they didn't have positive cash flow. And I'm sort of a discounted cash flow, dividend discount model, valuation-driven person, and said, I cannot forecast the NASDAQ. At the end of 1999, when you do the year ahead stuff as a strategist, I said, I'm really not all that enthusiastic. The Wall Street Journal castigated me for being on the more pessimistic end of the spectrum. And in March 2000, on the day that turned out to be the peak in the cycle, I was on CNBC and said, I think it's time to lighten up on technology. Why? Basically saying the consensus was wrong. Not that I thought that technology had not evolved dramatically, but I thought there was too much enthusiasm for it. Too much enthusiasm in the market, and also some companies had overinvested with regard to their actual physical investment in the category. So Glenn, I would use those two examples basically at opposite ends of the same process. And by the way, dot-coms were real, okay? But some of them were not. But the ones that survived have gone on to be very successful companies. It's a question of knowing how much to pay for them.
I want to come back to some of these what's hot at the moment issues in today's market in a second. But I want to ask you a question because we have a Federal Reserve meeting that's just about to happen. And we're at a juncture where inflation is well above the Federal Reserve's target. The labor market and economy are clearly weakening. The new numbers on the employment situation could hardly be described as robust, and revisions have been downward. At the same time, there's an enormous amount of uncertainty facing the Federal Reserve, at least to me. I'm more interested in what you have to say. This doesn't appear to be a very easy call. So what do you think the key sources of policy uncertainty are for the Fed? And then how does that uncertainty affect the market outlook? And importantly, how would companies react to that?
Sure. Glenn, you've laid it out very well. When that FOMC gets together this week, they're going to be looking at data for the economy, not just the labor data, but also a lot of the demand data, which clearly have weakened over the last few months. Consumer spending has decelerated, as one example. And the other piece that is not, I think, not getting enough attention is that business fixed investment has also decelerated very, very sharply. And so while we had seen some increases in equipment spending last year on the order of 8 to 10%, depending upon category, those numbers are down to 1 or 2%. Still growing, but growing at a much slower pace. So this is a Fed that I believe will be trying to balance its dual mandate. And this time, at least, I believe they'll be focusing in on the slower growth, because when I listen to their speeches and I read what they have written, that is the various voting members of the FOMC, I think that their near-term concern is more on the growth side than on the inflation side, that they feel they can take care of inflation later on, and also there is more uncertainty with regard to inflation. They're not sure how much of it is one time related to tariffs and some other issues. So I think my expectation is they'll do a 25 basis point cut this week, and you're asking what will the markets do? I think the markets have already built this in. If you look at basically the Treasury market, there's a 100% probability built in of a 25 basis point cut. I think that's what we're going to get, because this is a Fed that wants to move slowly and steadily as more data come in. And so how does the market react to it? I don't think there's going to be much of a reaction. Keep in mind what the Fed does is adjust at the very short end, the Fed funds rate. That's the rate at which banks borrow. Well, that's not where most transactions occur in the economy, right? Most transactions occur of households or businesses that borrow at 5 to 7 years. And if you take a look at the yield curve, you've already seen a significant steepening of that yield curve, in which investors are already expecting something like this to happen. So I'm not sure there's much of a reaction. My worry, quite frankly, is the equity market. The equity market has done very well, thank you very much, for all of us investors. And a lot of it has been driven by good economic news thus far, and the idea that interest rates will be moving down. And I assume you're all business students, you know that all other things being equal, if interest rates go down, the value of equities goes up, because the future value of those equities and the flow of earnings and cash flow is of greater value at a lower interest rate level. Okay, all other things being equal, lower interest rates means higher equity prices, but all other things are not equal. Because with this slowdown in economic growth that I think will be encouraging the Fed to lower interest rates, we're talking about slower growth in demand, slow growth in revenues. We're talking also, I believe, in the second half of the year, of some profit margin compression. Profit margin compression because the economy is slower, and also because of tariffs. What we know in cases where the tariffs have already hit is that companies are trying to take care of it themselves. They've not been passing it along to consumers. They cannot keep that up forever. So they will either have to increase the cost to consumer, right? Because tariffs are a sales tax on the consumer, right? We don't believe this fiction of other countries are paying the tariffs. That's not the way it works. So with tariffs having gone up, the company here either has to raise the price to the consumer or continue to absorb it themselves. If they raise the price to the consumer, it has a negative impact on demand, and if they have to absorb it, it has a negative impact on profits as well. So I think that profit growth, which has been quite good to this point, is not going to be so great in the second half of the year. And I will be watching the third quarter earnings reports very, very closely as they come in October. And what you need to watch is not just what they say about the third quarter, but also what they say will be happening going forward, the so-called guidance that they provide. And I think guidance in many industries is not going to sound very good. What does that mean? Not a fabulous experience, likely, for the equity market. Equities right now are priced as if things will continue to be good. And for many companies, maybe they will. But I do think that an increase in volatility is very likely.
Let me probe a little bit on that because you mentioned the 25 basis points cut that's likely. For the sake of argument, let's suppose the Fed decided to go big or go home.
Mhm.
So let's cut it a lot, 50, 100 basis points. Follow through the all other things equal in your argument.
If the Fed decides to go big or go home, the negative, we know what the arithmetic connotation is, right? The arithmetic is great. Interest rates are lower. Everything looks great. But what are the negative connotations? First of all, why are they going big? Are they going big because the economic data they're looking at is even weaker and they're even more concerned about a slowdown in economic growth? That's not so good. And the other possibility is maybe they're worried about others breathing down their neck, others in the administration. Not that the Fed is part of the administration, that's one of the issues. Maybe they're concerned about people in the administration breathing down their necks and saying, you better do this, or we're going to step on your independence as a central bank. And I don't think that would be viewed positively by the markets either.
I want to come to two areas of great interest in markets in the economy, both of which have some positive elements, both of which have some froth. Let me start with cryptocurrencies and stable coins. So walk me through how we should think about their role in markets and how should business people be looking at them?
I will start by saying that I'm on the skeptical side. And I suspect there are a number of people here who say, what? I've made a lot of money in crypto. Well, here's the thing that I would ask you to think about. How do you value a cryptocurrency? It's momentum, right? It's based upon whether somebody else is going to buy it from you. There is no underlying value. And the fact that crypto remains used primarily for transactions where the transactors don't want there to be anyone looking at it. 90% is for illicit activities. That's not a good sign. So we see that the industry has moved towards stable coins. And I happen to love that branding because how could you not love a stable coin, right? It's stable. So unlike a cryptocurrency where you don't know what the value is and it is highly volatile in its trading, stablecoin sounds great. There are some applications for stablecoin, but let's back up a minute. What is a stablecoin? It is a digital, let's call it a token, that is backed by what? A national currency, right? So it is a stable coin based on a dollar, or it is a stable coin based on a euro, or is it a stable coin based on an RMB? It is based upon an underlying currency. The benefit of a stable coin is, one could argue, that transactions happen faster. And so, maybe there should be digital currencies issued by various governments, but, and by the way, there are, but let's back up a second. I think that an analogy to a stable coin would be a money market mutual fund. Money market mutual funds were always viewed as good as cash, right? Because they would price themselves at $1 and they always traded at $1. You could always transfer in and out at $1 until you couldn't, right? In the financial crisis, there was what was referred to as breaking the buck on the money market mutual funds. And these things that were good as cash were no longer worth $1. Some of them were 99 cents or 97 cents. It wasn't terrible unless you really thought it was cash. And then you said, oh dear, I have a problem here. By the way, some that were not well managed went down much more than that. So when I take a look at stable coins, I say, well, there's a demand for it because not enough nations have created their own digital currency, and these are fast ways to transact. But it's not clear to me how we move forward, nor how these things should be regulated. Because what they are right now, in my view, are securities. Okay, a stable coin is basically a security.
There's a fight over that, of course.
Yes and
whether
no.
they're a commodity or a security.
Exactly, and I was just going to get to that. because the administration has basically told the SEC to loosen up on this. The CFTC is not quite sure what to do with it. And so there is this confusion, if you will, in terms of how it should be regulated. And I think that there is ultimately an opportunity here, if well executed, for stable coins and for digital currency, but we have to know what it is we're dealing with, first and foremost. And by the way, if the US had moved more quickly and had created a digital dollar, we might not be having this conversation at all.
So should we have a central bank digital currency for the US?
I am inclined that way. I know that there are a number of very thoughtful people who disagree for a variety of reasons, but I think given what has already happened, a digital dollar might be a good idea.
I want to take you to another area of both optimism and maybe potential froth, which is Gen AI. Sometimes when I speak to policymakers, I ask them to entertain the following thought experiment with me, that if we could grow a 0.5 percentage point faster a year, we would fix almost everything. We could stabilize the debt to GDP ratio at a reasonable level. We would have great living standards. And then, of course, the question is, where would that come from? And in the world, people say, well, how about Gen AI? And I can tell pro and con stories. But what I do know is that every time we have faster growth, we also have disruption. And that Gen AI is disruptive as well as positive. So how do you think about the uncertainties surrounding Gen AI, both for markets and the economies? And how do you think business leaders ought to navigate that?
We have another 2 hours?
Yeah, at least.
Okay.
They don't want lunch.
All right, so wonderful questions, very thoughtful, and there are so many different aspects to it. My apologies in advance if I just kind of bullet point it. First of all, we have seen obviously an explosion in investment by companies and individuals, by the way, in Gen AI. Companies that are buying the products, companies that are building the products, and users who are trying to sort it out. And I think what we have seen every time a new technology is invented, going back to the cotton gin and the railroads and so on, is that a lot of that early capital is not well spent. In part because some of it is the bleeding edge technology. Sometimes it was okay technology, but it wasn't applied appropriately and so on. And I think that we are hearing more and more about these kinds of instances. Companies, for example, retail facing, that thought chatbots would be the end all of, be all of everything they needed for customer service. And I'm a customer. No, thank you. I'm not really interested in how they work. Also, as a computer science person, I will tell you that much of what goes under the heading of AI isn't artificial intelligence. It's basically data retrieval, right? It's simple data retrieval. And the databases over years used to be digits, numbers. And what the large language models have done means that the data retrieval now can be words, but it's still data retrieval. And it's not necessarily intelligence. It's just really fast data retrieval. And there are benefits to it and helpful things, but we also know about the hallucination issues. And even for companies and medical institutions and others that are trying to use their own databases with clean data, they're not taking stuff from the cloud, they're finding very high hallucination rates, which means there still has to be that interface of somebody who actually knows something. Not everything can be fully automated. And you can tell I'm like speed dialing through this answer, Glenn, which I apologize, because I wanted to get to one part of your question. We did a Chazen session like this last year, and one of the students said, what does this mean for my employment prospects? And I want to go directly there. I believe that, yes, as you indicated, Glenn, it means that there's always some sort of disruption when a new technology is created. Just go back a few years. The creation of the Microsoft Office suite basically meant that there were fewer people who were in what used to be referred to as secretarial positions. People were doing their own stuff. But what happened to those individuals who lost their jobs? Most of them were retrained. Many of them were able to stay in their newly created positions, which were often higher value added, more productive, and they ultimately got paid more. Not everybody, but many. And so one of the testaments to how do we treat new technology in general is how do we prepare people for it, number one. Number two, what do we do not just for people who are dislocated, but also the people who are enhanced by it, right? One of the clear groups of losers, interestingly, in this, with the addition of AI tools, are computer programmers, right? The people who do simple coding are the ones who are in the greatest danger. Now, why is that? Because it is the iterative jobs that are at danger, right? So it's the iterative jobs in customer service if you're a retailer. It's the iterative jobs if you're a computer programmer and so on. So how do you prepare a career in an AI environment? You focus on domain expertise and focus on how do you use open AI to enhance your own productivity, to let the system, if you will, do the iterative, boring, repetitive functions so that you can think more broadly. And we do see some very fine applications of it. Most of the applications I have seen thus far are buried into companies. So for example, the financial services companies that are allowing their traders to use open AI systems to play what-if games, or are using it for risk determination, right? Because you have to manage the risk in financial services firms, be they brokerage firms or insurance firms, and so on. I also see buried in law firms the same sort of thing. But I hope you all remember this situation just a few months ago where a lawyer submitted a brief to a court, and referenced in that brief were cases that did not exist. Yet you heard me correctly. Basically, the OpenAI system, they had used OpenAI to do this, had hallucinated to the extent that it made up case law. Obviously, that is not a good use of it. There are other systems that are basically custom for a particular industry or a particular company that work much more effectively, but only under the supervision of somebody who actually knows something, be it a lawyer or a doctor or an expert in some other category. Did I answer enough?
I think that's very good. Because this is a Chazen global markets, I want to do kind of a two-part globalization question, if you will, and then I'm going to turn to you all. People talk a lot about geopolitics. You and I aren't defense specialists. I want to turn to geoeconomics, the use of tariffs, sanctions, things like that. How important do you think this is going forward, and how does it change business strategy? Second part of that question, is globalization dead as a result?
Okay. We are clearly in a new environment as it relates to trade policy. The United States has benefited for decades from the system that was created post-World War II, whether it was GATT or some of the other multilateral institutions that were created to kind of oversee the trade environment, to make sure that things were fair. The United States always presented itself as just one part of the puzzle. Other countries also were involved in the decision-making, but the United States largely dominated the way things were structured. As a nation, we benefited, but so too did our trade partners, many of whom were in very bad condition after the end of the Second World War. And we kind of brought them along, and we benefited as well. The current environment is very different. The Trump administration identified, as did previously the Biden administration and the Obama administration, areas in which our trade partners maybe were taking advantage of things, maybe we're getting a little too much help, and so on. And nevertheless, the disruptive manner in which trade policy is now being implemented, in my view, is not a good thing, primarily for the US economy. Effective tariffs already up from about 2% to close to 18%. Again, a sales tax. It's highly regressive rather, on the US consumer. I also think that we've irritated a lot of our friends. Instead of focusing our trade concerns with those other big economies that were taking advantage of us, we've gone after Canada. I have a warm spot in my heart for the Canadians, and to do what we've been doing, and also to Mexico. Our most important trade alliance in recent years has been Mexico, US, Canada. This has been the natural alliance. Most trade, most imports and exports in the United States have been in this with our neighbors. And here we are starting fights with them. And I don't quite understand that. Maybe you push on your friends more because you think that they're going to bend more. From my perspective, the countries that really need to be addressed are the bigger ones where we've not had the same sort of effect, if you will, in terms of actually changing trade policy.
And is globalization dead?
Globalization is not dead. Globalization, however, is shifting away from the US. And that's not a good thing, right? The US has been dominant in many ways, the world's largest economy, the world's largest financial markets. We have had a very significant presence as well, not just in the global economy, but in global geopolitics. What we're now seeing is that other nations are taking advantage of the erratic nature of US policy to step up and say, why don't you count on me instead? We see it in terms of China over the last few years, particularly since the Trump 1.0 administration withdrew us from discussions about a regional trade pact for the Pacific. Ever since we withdrew from that, China built its own regional trade pact within the Pacific. And by the way, within the Pacific, it's not just Asia, it's also Latin America, right? It's anybody who has a Pacific coast. We also have seen trade pacts, for example, between China and Africa. And so the United States, while still numero uno in terms of size, we're losing our dominance, and the dominance has shrunk a little bit, and we're also losing, if you will, our credibility, because what other countries are looking for and what companies are looking for is some consistency. Companies can deal, or other countries can deal with policies they don't like, as long as those policies don't keep shifting. And when I speak to my former colleagues at Goldman Sachs, or I speak to analysts located at other brokerage firms and others who are doing work of this sort, what they're hearing from companies is that the biggest problem is nobody knows where this is going to end up in terms of the ultimate trade policy. And so companies are basically like this. If they can, they're holding back on investment in equipment, they're holding back on hiring workers. They just want to see how things go. And one thing I'll be watching, Glenn, with regard to globalization is, what do the new supply chains look like? US companies and others built supply chains that are very complex over the years, but ultimately, benefited the consumer and also benefited those companies. What do the new supply chains look like? And I don't really know.
I want to open it up to all of you. There are people with mics, so if you raise your hand, try to call on you and get you a mic. Anybody got a question? Yeah, right here in the center, if you can get him a mic.
Thanks so much for the time today. Can you talk a little bit more about the fiscal situation here in the US and globally, the debt situation, and whether or not you think it's sustainable? If not, sort of what the paths and potential outcomes are?
Yep. Thank you for raising that issue because the fiscal situation is problematic. We have had a budget deficit in the United States each and every year since the Clinton administration, when we did have a budget surplus. And the way to look at it is not so much in terms of dollars, but rather dollars as a percentage of GDP. And looking at other nations as well in terms of what their deficits are vis-a-vis the size of their economies, because that's a metric of ability to pay. And the thing that is really very striking about the current deficit in the United States is it's very large, and the economy has been growing. You know, we expect deficits to increase when the economy is under duress. For example, during the pandemic or during the financial crisis, which began in 2008. What is disturbing is that that deficit continued to grow even as the economy was growing. And we now have a very large deficit. We are going to have to deal with some of the uh, optics of it, if you will, very, very soon, because on September 30th, there's a chance that we can get a government shutdown because the Republicans in Congress who are controlling the process disagree with one another as to what the new situation, the new budget should look like. You know, the U.S. is on a September 30th fiscal year. You know, so they can finesse it a little bit, they can extend it out a few days, a few weeks to actually, you know, before anything really hits the fan. But September 30th to me is a date that we should be watching to see how far along they've actually gotten in terms of doing anything. Now, Glenn made a comment earlier that I hope you caught on, and that is if only you could boost the productivity of the economy and get it to grow faster, you could try to grow your way out of the deficit situation. There are some countries that try to inflate their way out of the deficit situation. I hope we don't do that. But what can we do to grow our way out of it? Maybe AI helps us in that regard. I worry, however, that we are disinvesting right now in education. We are disinvesting right now in science and R&D, and typically it's that combination, right? Productivity is a function of capital and labor, the efficacy of capital, the efficacy of labor. And if we are not investing in the future, I worry about that. Now, that's not going to resolve anything for September 30th, but the intermediate to long-term outlook needs to look at that. And then, of course, and that's the revenue side and also the GDP side, but also the expenditure side. What the Doge people did, I would like to say it was not what they intended. The amounts involved really don't affect the overall budget because they attacked, if you will, some so-called discretionary spending. And I think that some of the things that they reduced, including spending on science, will actually prove to be highly counterproductive.
If I could just add one thing to that, because I agree with everything Abby said. When I mentioned that 0.5 percentage point of higher growth, I do have in mind how to get there. And how to get there isn't a challenge of science or economics, it's a challenge of politics. So if you wanted to get there, it's basic research, it's high-skilled immigration, it's permitting for electricity reform, which may sound boring to you, but try getting the AI without the data centers and electricity. All of that sounds easy in terms of engineering and economics. It's politics that's hard. The other thing is that the deficit situation is unsustainable, and all planes land. The question is, do they crash or do they land gradually? They will come down. And I think for the US, there's really two challenges beyond economists' usual complaining. We're going to have to raise military spending. And interest rates, at least in my judgment, Abby's the market maven, will be higher than people think going forward, both because the real interest rate is higher, growth is higher, and inflation's not coming down. That's not a happy cocktail for the deficit. So I'm glad you asked the question. It's one at least I worry about.
I agree wholeheartedly.
Yeah, sir.
Thank you so much, Professor. I'm hoping I can get your take on the idea of Fed put.
Fed put.
Fed put. Earlier, you struck it like a cautious tone about the equity market based on their performance, probably in the second half of the year. And I totally agree with that. However, I'm not sure how I can think about it as my investment strategy because, like, if you look at the equity market broadly for the past couple months, you feel like every news is a good news. Like, if the economy is weak, I think it's such an entrenched thought, even in mine, that the Fed is going to save the day in the end. So I'm hoping like to get a take of how you think about that and some of the trends that's happening in the past, I guess, 10 years.
Okay. There is a presumption right now on the part of many in the equity market that nothing can go wrong. If the economy is a little bit slow, interest rates will go down. If the economy recovers, that's great, and so on. And I ultimately come down to the idea of what's priced into the market. Excuse me. And at current PE ratios, and the current price to book, and the current price to sales of the S&P 500, I would say the good news is priced in. Doesn't mean that there aren't specific opportunities. And by the way, I'm not giving anybody here investment advice. I want to make it clear that this is not intended for any individual.
I'd be happy to. You just shouldn't take it.
Because when one gives real investment advice, you're looking at tax considerations for individuals, you're looking at risk profile, you're also looking at time horizon, right? So when I take all of that into consideration, there are different answers for different people. But when I take a look at the equity market right now and realize that the last few years, anybody who was in a market cap weighted index did quite well. Because there are a handful of stocks that really dominated the market, and they just kept getting larger and larger as market capitalization grew. And I would say that that market cap weighted index approach has left behind some other opportunities, some smaller and mid cap names, number one. Number two, the other thing that has happened in recent years is that the US equity market has performed far better than any other developed economy market. And there are some others that look to be priced in a better way. And yes, they're at lower PEs than the US. They also have lower ROEs than the US. So one has to do those kinds of adjustments. But my assumption is that we cannot count on the Fed all the time, because if the Fed is going to be lowering interest rates, we have to ask, is it good news or bad news? Are they lowering interest rates because inflation has come down? Or are they lowering interest rates because economic growth is problematic? And if it's the second, that to me is not great news for the equity market. The other thing to keep in mind, and since you're all Columbia students, is to recognize that we now have a capital stack, right? It used to be pretty easy, stocks, bonds, that's it. What we now know, of course, is in most investment portfolios, institutional portfolios, endowments, and so on, is that there's a stack of stuff, right? It's public equity, it's private equity, it's public credit, it's private credit, it's real estate, it's all kinds of other alternatives, and so on. And we have to recognize that there is a blending of those. When I take a look, for example, at the way some private equity instruments are now being traded, they too are being traded basically for perfection. And by the way, if the public equity markets don't do well, the private equity markets don't do well, right? Because you need to have an opportunity to sell. The thing we don't have very much experience with is the private credit market, which is relatively new, right? A lot of lending moved away from the banks and into private credit. And what we don't know is which of those managers have actually done a better job than others in terms of risk assessment. And the unfortunate thing, and we know this as economists, is you need a whole cycle to figure it out, right? You need to see when things go bad to find out who the good managers were versus who were the ones that benefited from a rising tide and the use of leverage, right? They made a quarter and they levered it up, so they told you they made 50 cents. But on the way down, if they lose a quarter, will they also lose 50 cents? We don't know yet.
Questions? Yeah, right there.
Um, thanks, Professor. Just for the sake of argument, I'd like to elicit your views.
Can you speak up a little?
Just for the sake of argument, I would like to elicit your views on sort of your reservations on the current administration's approach to tariff and how we treat our trade partners. So, on the tariff front, you mentioned deficits as well, but there are reports that come out that says that the tariff has managed to raise revenue that can sort of decrease the deficit. And on the trade partners front, there are news report on Mexico introducing tariffs to Chinese EV vehicles. So the idea is that when we irritate our trade partners, they also come into the fold to what our agenda is. So in that sense, don't you think is a good thing for the US economy where the tariffs, the idea is to sort of shore up our industry so that jobs do come back, and on the way we treat our trade partners, it's to bring them into our sphere of influence?
Okay. Two very interesting points. Let me address both of them. First, the administration has reported that X number of billions of dollars have been raised in tariffs. And they've said, and we've gotten these tariffs from other countries. Let's keep in mind the fact that those tariffs are in fact sales taxes paid in the United States. So those revenues are tax revenues. And I would argue that tariffs are not an efficient way to raise taxes. If you want to raise taxes, do it in a way that is more obvious than this. And I believe that these sales taxes through tariffs are in fact highly regressive. And we do see that consumers, middle income, lower middle income, are the ones where consumer spending has slowed the most. With regard to the actions taken by other nations, terrific. If these tariffs encourage them to do something that we want them to do, I hope that we see more of it. The drug inflow is a very important point. And the other important point that you mentioned has to do with reshoring of various industries. And here we need to be very careful. And I know that Glenn doesn't believe in industrial policy.
It's true.
There's one part of industrial policy that I happen to feel more comfortable with, and I've actually done some work with the Defense Department on this, and that is there are some industries that are important for national security. And it is those industries that I would like to see spend more of their capital here than in other nations. And it's a whole host of things. Some of it is production capacity. Some of it is what's now getting so much attention, rare earths, and so on. But there are some things that I believe we should, if we can, reshore, if not to the United States, at least to friendly countries. And a lot of this was actually Canada and Mexico, if I go back to that, where the Canadians and the Mexicans were in fact producing a lot of stuff that is important for our technology industry, is important for our national defense. And I'm happy with things that are done by nations which are friendly to us, and I don't want to poke the bear, if you will, in terms of irritating them when they're helping us out in this regard.
I think somebody over here had one before. Yeah.
Yeah, thanks, Professor, for coming and for your time.
Sorry, where are you?
Oh, I'm here.
Here.
Oh, great, thank you.
Yeah. I guess I have two questions more related to the Fed and the rates trajectory. So the first question is, I see because of the news, the data coming out and the very weak labor market, the market is currently pricing 3 cuts for this year. So I'm just curious, like, what's your opinion to that? Like, do you think it's fairly priced or it's like overpriced? And then like, we're gonna have like new Fed chair from next May. Trump is probably appointed a new, more dovish person into the seat. So I'm just curious how you think about the rate trajectory in the medium term. And then the next question is, I'm just curious, do you see 50 basis points cut is still visible in September? Because I see last month just Treasury Secretary Benson come to CNBC television, and he just making the argument that because if the Fed seeing such downward revision in the labor market, and it turns out like the labor market is really weak, the Fed should be cutting the rates in the last few months. So do you think 50 basis point cut is still possible in September?
A lot of questions, all related to one another. And I will basically say the following, not necessarily in the order that you asked it. I don't think the Treasury Secretary should publicly be saying what the Federal Reserve should be doing. I believe that central bank independence is essential, and it's central bank independence when one compares nations that have central bank independence versus those that don't. The ones with central bank independence tend to have lower inflation and stronger growth and a much more stable economy than the ones where there is interference. So number one, I don't think Mr. Besson should be making his comments in that public manner. Historically, secretaries of the Treasury have met with the chair of the Federal Reserve privately over lunch on a regular basis, and I think that would be a better forum for that discussion, number one. Number two, you're right, what the markets have built in primarily is the expectation of 3 rate cuts. That is the presumption, because the presumption is that the economic data over the next few quarters will get weaker and weaker, basically going from a 3 to 3.5% growth, real GDP, down to about a 1%. I believe that this is a Fed that wants to behave in a step-like fashion. So I think most likely is 25 basis points this week. You'll all find out in 2 or 3 days if I'm wrong, right? And if it is 50 basis points, apologies, I did my best.
Yeah.
But if they do 50, then it's not clear to me that the next one is another 50. I think that we have often seen Federal Reserve take one big step and then kind of wait to see what the economic consequences are of that change. Now, did I answer all of your questions in that regard? Okay, good, thank you.
More questions for Abby? Yes, ma'am. You could give her the mic, it's right here.
Thanks so much. I have a quick questions about China. Obviously, in the last few years, I think the global sentiment on investing in the country has soured quite a bit to the extent that JP Morgan put a report saying China is uninvestable. Do you think that has changed, or do you think the investors are approaching the country differently, and the factor like geopolitics is playing a bigger role than the return?
JP what?
Yeah.
I'm sorry.
Yeah.
I
Those second-tier competitors.
Yeah, I have a lot of confidence in JP Morgan. They do good work. First, you're right. There was a period of time when China was viewed as uninvestable. Why? Because the Chinese market had performed exceptionally well pre-pandemic, right? And then you get to the pandemic, and I'm going to really shorten this, so my apologies for giving you the comic book version. The Chinese mishandled the pandemic. Rather than using one of the globally available vaccines, which do work, by the way, and were available if the Chinese wished them, they insisted upon using the Sinopharm vaccine. The Pfizer vaccine, the Moderna vaccines were both about 90% efficacious. The Sinopharm was 23 or 24% efficacious. And so the Chinese instead shut down the economy, right? So having this extended period of quarantine really messed up the economy, and the Chinese economy didn't come out of it. Combine that with the idea that there had been prior enthusiasm on the part of international investors in China. There was a lot of money that had been invested, usually through either indices, or there were a handful of active managers that had accumulated a lot of money. And then the international investors that had participated that way basically said, I'm out of here. Because there was an extended period in which the Chinese economy was not growing, when the United States was doing well, Europe came out of recession, and so on. That's history. JP Morgan. Where are we now? The Chinese market was the best performing market last night. One day doesn't make a market, but you can see that over the last several weeks, the Chinese market has been doing far better, in part because there are reservations about the consequences of US trade policy and the way it plays into the benefit of the Chinese, who are building their trade alliances within Asia, building their trade alliances in Africa, and pushing against the United States in a whole host of categories. And so the Chinese market is looking better in that regard, number one. Number two, the international investors who pulled out of China now have capital. They're looking at a US equity market that looks, let's call it fairly/fully priced, and they're saying, where else do I want to be? And so some money is being reallocated out of the United States into other markets, and China is one of those beneficiaries. So I do think that China is investable. The problem going forward, of course, is that the Chinese government doesn't always make everything available. So you have to be careful in terms of who your investing partner is, number one. And number two, it doesn't appear that the real estate bubble, as it relates to some financial institutions, has been fully resolved. That suggests that one needs to be very careful. But as I look at global money flows, money is going back into China in actively managed accounts.
Let me ask you kind of a lightning close, Abby. If 10 years from now, the US will have turned out to have been much better than sitting here today, we think, in terms of economic performance, what will we have missed? What will they say we missed? Is it that AI was better than we thought? It's that some of the public policies you were critical of turned out to be not such a big deal? Is it luck? What would it have been?
I am hoping that some of the policies of which I am critical get modified. I'm hoping that if they are not turning out the way the administration would like, that there is a willingness to reassess for the benefit of the nation, number one, and for the benefit of the legacy of the people involved. So that's one aspect. Number two, I always look relatively. What's happening outside the United States? And are other nations making their own mistakes? And right now, I do see some mistakes and I do see some problems. I'm sure that you're all aware that there have been enormous political tensions in France, in the UK, Germany, and so on. And all of this does get in the way of sensible economic policy making. The two countries I'm looking at very closely, China, we just discussed that, where they seem to be moving now in the right direction, getting out of their own way, not that there aren't still some problems. I'm looking at Japan and Korea. Also, having had some domestic political issues, why not change the prime minister again, in both countries? But these are also resilient economies. Japan, for many years had a very low return on equity corporate sector that has kind of fixed itself. Returns on equity in Japan had been running at 2 or 3% for many, many years, compared to 18% for the S&P 500 in the United States. And the Japanese are now running on average about 10% ROE. So there's some resiliency there. And then Korea, to me, is also quite interesting. And so to answer your question, where could we be going wrong? One is, I hope that policy here gets adjusted if needed. I think it will be needed, but let's see. Number two, relatively, we still look okay because other countries have their problems. Number three, I am hopeful that the United States will reestablish its friendly relationships with Canada and Mexico, and also Japan and Korea, because these are very important nations for our supply chain at the advanced level. So that's what I'm hoping happens. And then finally, with regard to AI, it's not just investment in AI directly, but as you mentioned before, electricity generation. Anybody here know where the #1 data center area of the US is located? It's Northern Virginia. Northern Virginia's utility company is called Dominion, and Dominion is out of space. They've got nothing, which is why you're now seeing data centers being moved to places like Texas and Florida, and so on. So Glenn's point about having appropriate regulation to encourage basically this important resource for technology, whether it's AI or something else, is critical. And I'm hoping that we do this. And one of the answers to doing it is alternative energy. It's the wind farms. I don't think wind turbines are ugly, but whatever. I also don't think they cause cancer, will kill whatever. So we've got the wind turbines, we've got solar, and then we have nuclear. And I think if we get our act together in terms of using these alternative forms of energy, all of which are safe, then that's something that could, in fact, enhance economic growth.
Well, I can't tell you about the future of Canada or wind turbines, but I can tell you that your future includes lunch up there. Join me in thanking Abby. And
Thank you.
at the Chazen Institute, we hope we'll see you at future events. Thank you. Enjoy the lunch, and thank you, Abby.